Thank you so much for joining us today. The purpose of this video is to inform you of what's going on with the market. With me today is Cherese Hoskins. She is with RPM Mortgage and she's been in the business over 12 years. She's very knowledgeable. And so Cherese, tell us what's going on with the market.
So, as we've all heard through the media, the rates have risen, and they've risen about 0.5 point since the election day up until December 14th. What that means is that with the interest rates rising, our economy is moving again. Unemployment numbers are down. Economy is stimulating. So what we're doing is we're moving out of a historically low environment for interest rates into a traditional interest rate atmosphere. December 14th, when the Feds got together, they elected to hike the rates, and what they hiked was not the interest rate, but the Fed funds and what the banks charge each other to lend money. So that directly impacts home equity lines of credit and auto loans. So the last time that happened was December 2015, and then they thought that it was going to happen throughout 2016. It did not, but finally December 14th it did.
What does that mean to people who have HELOCs?
So what that means is that HELOCs are tied to it's a prime rate plus a margin. So we've been spoiled for the last 10 years. We've had prime rate at 3.25. So now it's moved up, and with it moving up and tying to a margin, the interest rate will go up. So, for example, if you had a $300,000 loan with a HELOC, the impact on the payment's about $88. If you have a $636,000 loan, the payment's going to be impacted about $177. Yeah. In the past, the traditional home equity line of credit interest rate is about 8.36. So right now, we're still in the 5s.
How does that affect the home buyers out there that are on the fence? You know, a lot of them is like, do I buy now? Do I not buy? Can I wait? What do you recommend?
So I recommend just going over and getting your pre-approval revamped. So if you've already been looking, or if your home buyers have already been looking, just have the pre-approval reevaluated just to make sure and certain that they're shopping in the right price range. I feel that with 2017, we're going to have some rising rates. Due to the Feds and their meeting, that they're anticipating the Fed funds, meaning the HELOC rate, is going to be hiked maybe 3 times in 2017. So it would be a good idea to really pinpoint a time frame to purchase and stick with it.
Okay, yeah. That sounds pretty big, 3 times. So as far as their purchasing power?
Well, with rising rates, it makes the purchase power capped a little bit. So that's where if we were pushing the envelope and we were really at the maximum pre-approval, with rising rates, we're going to want to reevaluate that pre-approval to make sure that they're shopping in the right price range. The good news is that the loan limits are rising in 2017. In fact, they're effective now. That Fannie Mae and Freddie Mac have decided that due to the growing economy and rising housing prices, that the loan limits need to adjust per county as well. So if you need your clients to know the loan limit for their county, I can absolutely look it up for you.
What else do you think the consumers should know about what's going on with the market?
Well, I think that everybody, you know, with the media hyping up all the interest rate hikes and the Fed's meeting and the new president-elect in place, I feel that we're moving into a very traditional housing market, that there's future appreciation, that the interest rates are going to be moving into a territory that they call normalcy, and that we're no longer in recession. We're moving out of the woods, and we're in a traditional normal market with normal appreciation, and the rates are moving up to a normal interest rate. So we're no longer historic lows.
So when you're saying normal, what does that actually mean to the consumers out there?
That means that over the last 10 years we've been spoiled.
Yes, we have.
That interest rates were at all-time lows, historic lows, and that's due to our economy. And now we're recovering. And so when I mean normalcy or traditional, the traditional appreciation rate is 3 to 4%. So instead of seeing a depreciation, that's gone away. Instead of seeing an appreciation rate at 10 or 11% in 1 year, that's going away. So we're moving into a normal appreciation, which is about 3 to 4%.
Great. Well,
per year.
Yeah. So Cherese, thank you so much for joining us today, and thank you for watching this video. If you have any questions, feel free to give us a call.